TV18 and you're watching CNBC TV18.
Hello and welcome to Big Deal. Today we have with us the co-founder of Everstone Group, Sain, joining us straight from Singapore. Samir, so good to have you on Big Deal. How do you want to be addressed here? A big restaurateur, since you have so many restaurants in your portfolio, or maybe a big real estate developer, or just a pure play private equity player?
Just Everstone Group is good. I don't think in India we need very box definitions. You know, it's an organic place and there's a lot to do, so we try and do the best we can.
Right then, let me begin by asking the large transaction that you have just closed. You formed a joint venture with CPPIB of Canada for developing logistics parks, industrial parks. Give us more details on how much of money will really flow in and what do you intend to do?
Look, I think, you know, we have a business called Indospace. Indospace is the largest owner, developer, manager of warehousing and light manufacturing, largely logistics facilities across India. We're a national developer. And we've been doing this for a few years and very quietly and kind of building it behind the scenes. What this joint venture does is that we partner with CPP, where CPP is the majority, in a new vehicle called Indospace Core. Indospace Core then acquires the ready, fully leased facilities that we have within Indospace development. They also commit to buy all the developments that are currently under construction. As soon as they're fully developed, as soon as they're fully leased, they will move into Indospace Core. In addition, that frees up a lot of capital for us, and we'll raise some additional capital, and we will go and develop further greenfield development. So this is a very large transaction. It's a massive commitment for CPP. It obviously is a very large transaction for us, and it runs into, if I look at the entire series over the next many months, you know, into north of $1.5 billion.
So it's a large transaction with a substantial amount of logistics parks under your belt in this particular joint venture of Indospace Core. So Samir, what is going to be the end game as an investor to really do value unlocking and for the returns going forward? REITs and InvITs, which are the hot topics right now of discussion, some of the InvITs have already come into the market. Is that going to be the end game for value unlocking for you as an investor?
Look, you know, there are many options. You know, I don't think too much about the end game when the opportunity set is significant. I think, you know, once REIT legislation becomes a little clear and maybe a couple of people lead, this becomes something that definitely is a possibility. But there's nothing wrong with just owning ready assets that are leased, that provide a very good income with extremely high quality tenants, and especially in an environment where with a lot of movements like GST, Make in India and others, create good momentum in terms of leasing and high quality tenants that usually sign up for very long-term leases. So we're very happy with the income. We're very happy if the REIT legislation comes in and we take this business public. Either option.
So give us more sense about this large transaction. So $500 million will first come from CPPIB in buying the complete projects, and how will it take it forward, and what is going to be the final targeted amount of the million square feet of logistics park that you are looking at acquiring under this joint venture?
So the new vehicle, which is the joint venture in which CPP is investing, the first tranche of this is to buy our existing ready, fully leased assets. So that's, you know, around 12 million square feet across the country in 13 or I think 14 different developments. So that's the first tranche, which is $500 million. The second tranche is as our assets that are under development across the country again get ready, they will move into Indospace Core, or at least Indospace Core has the option to buy them. And you know, look, those numbers are floating, but bottom line is it's probably a little over 20 million square feet, which, you know, we would value depending on what the value is, but I think call it $700 or $800 million. And then there is a entire new greenfield development that we undertake to develop another 20-30 million square feet across India. So I expect the whole package to be about 50 million square feet, of which Probably we are 25% of the way there in terms of finished and ready assets, but we're well on our way. We have a national infrastructure. We are good at what we do, and I think that we've been able to execute this business in a reasonably good and fast manner.
Can you give us a timeline of the targeted 50 million square feet of logistics park in this joint venture?
Yeah, it's like asking how long is a piece of string in India. We have no idea, but if I look at by a historical track record, generally I would expect this to be hit in the next sort of 5 to 7 years. We should probably get to at least 35 million in the next 36 to 48 months.
So Sameer, with this large investment that you have lined up for the logistics park, now we know that distribution channels are going to be extremely important under the GST regime, which is the buzzword right now. So is that what you're trying to capitalize on?
Look, it's timely. I think there's three pillars that I think help us in this environment. In no particular order, I think the fact that the government's done an exceptional job in building roads across India, and I think people haven't talked about that a lot, but road infrastructure, especially connecting major cities, has improved, continues to improve. Road construction continues to be at a pretty record high. It's hard to create a lot of interstate transportations of goods and services without having suitable infrastructure on the logistics and warehousing side. So I think we've benefited from that. The second thing is GST. If you look at the universe that we live in, it's been very complex. You have hundreds and different minor tax jurisdiction, octroi limits, and what GST will allow is a more uniform tax code where people can actually then rationalize their logistics. So for example, a typical consumer business that's of scale will have hundreds of godowns or small warehouses across India outside various octroi limits. With GST, they can move towards a more Western model, which is actually very sensible, which is mega warehouses in specific areas and then use those to rationalize all these different tiny warehouses they have. Now, the truth is those mega warehouses don't exist anywhere in the world, anywhere in India specifically. And we're probably one of the few, if not the only, that actually develops and manages these warehouses. So that plays into us, into our business quite well. The third is Make in India. Not only do we do warehousing, we also do light manufacturing within our industrial parks. And so we've seen a pickup in, things like auto components or assembly, a few other things that I would regard as just light manufacturing as opposed to heavy industrial manufacturing. So that's a third theme. So, I think the timing has been good for us. I don't think we foresaw all this when we started the business. Luck is important, and I think hopefully this momentum continues.
So you've been lucky, and no one's complaining about that.
Yeah.
But let me ask you about another offshoot of your, development that you have done under Everstone Group. You've built malls in the past. Real estate was one big thrust area for you. So is that also on the table? Are you still going to develop more real estate?
Look, we built a lot of malls. I think we were early. Before retail really opened up for foreign retailers and for foreign multi-brand and single-brand retailers. And I think we struggled. It was a tough thing for us. Having said that, we invested in a total of 17 malls. We built 11 ourselves from scratch, leased all of them, managed all of them, and actually have, as of last week, sold all of them. So we actually don't have any more malls. We've actually sold all the various malls. It wasn't a great outcome for us. I think it's going to be a great outcome for the people who bought them and are now benefiting from the upswing. People like Phoenix Mills, who've done an outstanding job, and I think will continue to do an outstanding job. So I think it's a good time to be a mall owner. It probably wasn't a good time to be a mall owner 5 years ago.
All right, so that was Everstone Group's the overview when it comes to the infrastructure real estate space. But Sameer, stay on with us. When we return on the other side, we are going to talk about another hot topic of discussion, another hot area, which is financial services area. And Everstone Group has fair bit of investments there as well. So we'll focus on that when we return on Big Deal. Welcome back. You're watching Big Deal, and Samir Sain of Everstone Group is right here with us. So, Samir, I want to focus on your financial services investments as well. Are you going to ride the valuation game right now and ride the high valuations that financial services is commanding in the market, and probably an Indostar IPO this year? And how about Hinduja Finance? That was also dressing up for an IPO sometime back.
Well, Hinduja Leyland Finance, we actually had filed to take it public, but then we felt that the opportunity to grow the business even more rapidly in a private manner was better, and the family, as you know, Hinduja family, Ashok Leyland, combined own the majority. We're a minority player, and we've been very, very pleased with the business is done. They've been exceptional partners, very professional. So we just decided to do a rights issue, put in more capital ourselves, and continue to grow. My sense is at some point that IPO will happen, but I don't think it's going to happen in the next few months. Indostar is a little different. Indostar is something we control, we run ourselves, we created, and I think that there's a high probability we'll take that, at least file to go public later this year. As you know, we have a fantastic new CEO for that business, and we have an exceptional team. And as we grow the B2C business, we already have a very strong B2B business. I think that we will probably come to market later this year.
So on Indostar Capital, there had been a lot of reports also on Guneet Chadda joining in. Now that you have a CEO, a new CEO coming in from Shriram Group, R. Sridhar, with that talks with Guneet Chadda, or Guneet Chadda really joining Indostar Capital, is that off the table?
No, listen, I mean, we spent a lot of time with a lot of extremely talented people. As you know, Guneet is an exceptional person with a phenomenal track record and top talent, and a good friend. And I think, after speaking with a lot of people, it's a two-way street. I think both have to find the right fit. We just felt that Sridhar fits the business well, and it wasn't necessarily just our choice. It's, two people have to see the same vision and see the same common goal. Given that our focus is building out B2C, and Sridhar's experience is phenomenal, with the Shriram Group as one of the sort of pioneers and leaders of part of their business. That's his mandate, and that's what he's building out.
All right, Indostar Capital really dressing up for an IPO by end of this year. So we'll keep an eye on that one. But what about exits in consumption space? Because you have a fair bit of investment when it comes to Everstone Group in various consumption areas. You have investments in even Ritu Kumar and various restaurants and many other healthcare chains as well. So how does that figure, and are you on exit mode on any of them?
Look, I think there's a difference between exit and IPO. As you know, we recently took a couple of businesses, exited a couple of businesses, took a business public. My sense is that we have a pretty good pipeline of very strong, healthy businesses. Modern Foods is shaping up to be an excellent business. You'll see the new ad campaign, the complete new rebranding, new packaging, and a complete new personality for Modern Foods within the next 2 or 3 weeks as we launched the new look. Burger King is now at its 100th outlet. We opened our first outlet 2.5 years ago with a complete supply chain and a menu. So I think that's another business looking very good. So I think we have a pretty good arsenal of strong businesses. I don't think we're in a rush. Our capital is very long dated, very patient, very hands-on, at the right time.
So clearly, Samir, given the kind of focus you have and the amount of deployment you've done to consumption sector, the consumption theme really is upbeat in India.
It does. If you really think about it, you have a phenomenal sort of growth trajectory in just the Indian consumer's balance sheet. If you just look at the Indian consumer, they're young. They're not as leveraged as you would see in other economies. The income per capita continues to ride extremely well. And, I think that there's a lot of other factors that are leading to an increase in consumption. Now, you just have to be very careful about what categories of consumption. So some are obvious, like healthcare, education, where you're seeing very strong trends. Others are a little tricky. Luxury in India has always been very tricky. On the other hand, FMCG has been pretty interesting depending on the categories. Given that we have businesses that range from health, wellness, beauty, food, beverage, healthcare, education, I think we get to see a very good spectrum of what works and what doesn't work. And in our venture capital business, which is in partnership with Deepak Shadatpuri, DSG Consumer, we get to see very, very early stage consumer businesses. So we're very positive on the theme. We think that there are landmines out there that you have to be careful. But overall, we think structurally for the next 10 years, it's going to be a phenomenal place to be.
So from what you said, I want to pick on one point. You said there are some landmines as well. So what is it in consumption basket that you don't like, you find them risky to invest?
Look, it's view driven. I think different things work at different times. I think, we struggle with what I would call anything that's luxury or high end. We've not found that to be a very attractive place to be. I think even within categories, there are subcategories that are complicated. So if you look at food, packaged foods, overall, very exciting category. We have a bunch of businesses in there. Now, frozen foods, microwavable foods, more challenging. Beverages, unless you're a niche player, very hard to take on the majors because they outspend you. Same thing in FMCG. If you look at what Vinny has done, effectively, it's just a massive marketing machine. It's a very different strategy. The product becomes less relevant. So there are categories within categories that are hard to play, and then there are broad categories like, something as boring as bread. Fragmented market, big category trend in terms of bread consumption. Probably our only business that actually went up 5% in sales during demonetization. There's a very old economic theory called Giffen goods theory, where people trade down and I guess rather have a sandwich at home than go and spend a huge amount of money at a restaurant. So I just think that you have to be very thoughtful and very detailed. In India, I've found that if you make decisions based on macro and invest in the micro, you can get killed. The micro has to add up to the macro.
All right, so the luxury space, so you're looking more of a volume play when it comes to the consumption theme. All right, hold your thought, but you have some very interesting investment philosophy as well, Sameer Sain. So we'll get back on the other side and talk about that. Stay tuned to Big Deal. Welcome back. We are in conversation with Sameer Sain of Everstone Group. So Sameer, tell us about your investment philosophy. What are the chief criteria, eligibility criteria when you are putting money into any particular company or asset? And also you have a very interesting thought on ROTI and ROI, return on time invested, and return on investments.
Okay, you're referring to our last conversation we had, but I'll pick it up. I think there's a bunch of things we look at, right? Wide open spaces. Generally, we like wide open spaces. We don't like to invest in businesses where a few players dominate the space or are monopolistic in their behavior. We like spaces that are fragmented and open. The second thing that we love is to be able to control a business. What we found is, unless it's an exceptional business where there's a fabulous leader, where there's a lot of art the leader needs to demonstrate versus science that an institution can demonstrate, we just prefer to be in control of the situation. So 70 to 80% of all our investments are controlled. In real estate, 100% is controlled. In venture capital, you can't do that because it's very early stage, and in fact, we're a minority in every venture capital investment we make. So that's another thing. We love to be hands-on. We love to operate businesses. Fundamentally, my view is that we do simple things in a complex environment. Selling bread is a simple thing. Selling a burger is a simple thing. But when you start taking into account that on any given day, 50% of Indians are vegetarian, and you've got to have 2 separate kitchens, and you've got to have a supply chain and tastes of products that suit the Indian palate, it gets complex. The last thing is, as you said, ROE versus ROTI. Return on equity is important. Capital is important. Making money on your money is important. But, in a country like India, you can also spend an extraordinary amount of time just being busy without really accomplishing anything. So return on time invested, ROTI as we call it internally, ROTI, is very important. You've got to have dal, which is capital, and you've got to have roti as well. And that's sort of how we use the analogy internally. You've got to invest your time sensibly.
All right, Sameer, and just to end this very interesting discussion, I want to ask you about Everstone Group's strategy going forward. Is there any new area that you're looking at investing in, apart from the areas you're already present in? And what is the deployment as of today for Everstone Group, and what is the outlook going forward?
Look, post this CPP-IB transaction, the group has about $4 billion US dollars in assets, of which about $3 billion is invested, largely in India across private equity, real estate, venture capital, and different avenues. Everstone Group itself, employs hundreds of thousands of people across India. Look, there's a lot of things that are important to us. Making money is very important to us, but also making sure we run really well-run, well-governed, high-quality businesses, which we think over time will command a premium, is also important to us, and we've done that consistently. Look, there's no new thing. I mean, we just do the same thing. We try to do it better every time. We want to be a world-class investor. There is no reason. People keep asking me, do you want to be the next Blackstone and do you want to be the next TPG? I just say I want to be the first Everstone. There's no reason why a country like India can't produce a world-class investor. There's no reason why you can't become a top real estate developer if you work hard within an 8 or 9 year period. Today we'd be amongst the top 2-3 real estate developers in the whole country, and you can do it. So I think that it's important to put your head down, work hard, roll up your sleeves, and keep doing what you do better. And that's our philosophy. All
right, Samir Sain. Good luck to Everstone Group's team for all the future investments and exits as well. Thanks so much for spending time with us on Big Deal. Thank you so much.